Hello again. Uh, Excuse my voice. I've got a slight cold here I'm dealing with, but we will be going through in these next few videos, Chapter 4 on accrual accounting concepts. So in this chapter, we'll focus on the concept of accrual accounting. That is the idea that we need to recognize revenues and expenses in the period that they are realized or incurred. On slide 3, in this chapter, we're going a few steps further in the process of recording and posting transactions and getting ready to close the books at period end. To get to that point, we need to understand why it's important to accrue amounts for certain accounts via adjusting entries and how the adjusting entries fit into the closing process. This chart shown on page 164, I'm on slide 4 now, of the text captures what we will be covering in chronological sequence from left to right. The first 4 boxes are in that sequence for real-world accountants, and then we look at the end of the chapter at some earnings management and Sarbanes-Oxley issues. On slide 5 now, to understand why we need to use accrual accounting and accrue certain items via month or year-end adjusting entries, we need to realize that the artificial cutoff of month or year-end drives the need for this, because the business doesn't just stop operating at the 31st of the month or the last day of the year. So on slide 6, this question addresses the artificiality of dividing the economic life of a business into these time periods called months, years, or quarters. This is what the periodicity assumption is about. So the correct answer here about the periodicity assumption is C. The economic life of a business can be divided into artificial time periods, and that in fact is necessary for proper financial accounting. On slide 7, when auditors come in to audit the books of a company, one of their key tests is doing a revenue cutoff in which they observe and test what the company does to recognize revenue in the period it's earned, especially revenue earned over the last few days or weeks of the accounting period. For example, a service performed on the 31st of the month may not be invoiced until a day or two later, putting that into the following month. However, the revenue was earned the day the service was performed, that is the 31st, excuse me, and must be recognized as such. It also doesn't matter in this example when cash payment for the service is received from the customer in terms of when the revenue should be recognized. On slide 8, the example on this slide provides the type of illustration I was just talking about. That is, the service was performed on the 30th, and that is when the revenue is recognized, regardless of when the payment for the services was received. On slide 9, on the expense side of things, it works in much the same way. So the expense recognition principle requires expenses that are incurred to support revenue generation to be recorded in the same period as the revenue is earned. So the association of expenses to revenues. This is obviously key in getting the net income right at period end, and therefore is another area the financial auditor looks at closely during the year-end audit. As stated in the text, you'll often hear the expense recognition principle referred to as the matching principle. That is because of the concept of matching expenses to the revenues with which they are associated. On slide 10, this illustration, which is shown on page 165 of the text, captures the periodicity assumption and the revenue and expense recognition principles, which as shown are a part of GAAP, or Generally Accepted Accounting Principles. Slide 11 is showing a real-life example here, and saying basically in the question, what motivates sales executives and finance and accounting executives to participate in activities that result in inaccurate reporting of revenues? Well, the answer, sales executives typically receive bonuses based on their ability to meet quarterly sales targets. In addition, they often face the possibility of losing their jobs if they miss those targets. Executives in accounting and finance are very aware of the earnings targets of Wall Street analysts and investors. If they fail to meet these targets, the company's stock price will fail. As a result of these pressures, executives sometimes knowingly engage in unethical efforts to misstate revenues. As a result of the Sarbanes-Oxley Act of 2002, the penalties for such behavior are now much more severe. On slide 12, this slide highlights the major differences between accrual and cash basis accounting. That is, accrual accounting, which is in accordance with GAAP, requires transactions to be recorded in the periods which the events occur, even if no cash changes hands. On the other hand, on slide 13, cash basis accounting is not in accordance with GAAP and is used for tax, not financial accounting purposes. On slide 14, you can see from this example that the accrual basis provides a more accurate picture of what went on regarding the economic event. That is, the painting of a building for an agreed upon fee or revenue amount. That is because accrual accounting uses the revenue and expense recognition principles to ensure that both revenues and the associated expenses are recognized in the proper period. In the cash basis example, there is no such matching, and that throws everything off, as you can see. So on slide 15, we have a review question. Hopefully you can see answer D as false because this describes the cash basis of accounting. A, B, and C all have to do with accrual basis accounting. Slide 16, the answer to the question is contained within the story. That is, Apple was required to provide continuing services, software updates, etc., over a 2-year period. And that was the reasoning behind spreading the revenues over that period. You can see page 223 of the text for further discussion on this. On slide 17, adjusting entries are necessary because of the periodicity assumption and the revenue and expense recognition principles. However, assets and liabilities can be affected as well. That is why the slide and text make the comment that each adjusting entry includes an income statement account and one balance sheet account. We'll see some examples of this shortly. On slide 18, this slide reiterates what we've been discussing about adjusting entries and why they must be made. We have another review question here on slide 19, and after the recent discussion, hopefully you can see why D is the correct answer regarding adjusting entries. Adjusting entries are made for all the reasons spelled out in answers A, B, and C above. On slide 20, here are some examples of adjusting entries that fall into one of two categories: deferrals or accruals. Deferrals have to do with advance payments for expense items that are considered as assets before they are used or consumed, such as insurance coverage or office supplies, as a couple of examples. Or deferrals can involve cash received in advance for a product or service to be delivered in the future. In each of these cases, as we have already seen in Chapter 3, a journal entry is needed to record the prepaid expense or the unearned revenue, depending on the situation. As the text states on page 169, a deferral is a cost or revenue that is recognized in a later period than the point when cash was originally exchanged. Accruals represent the opposite situation from deferrals. In these instances, revenues have been earned in the period but have not yet been recorded or received in cash, or expenses have been incurred but not yet paid or recorded. Going back to a previous example, it could be that sales may not have been invoiced yet and won't be until the following period. Still, the sales that occurred during the current period need to be recorded via an adjusting entry. The same holds true for accrued expenses. Let's say the payroll pay date is not until the week after the current month closes, but it covers a 2-week period spanning the current and following months. The portion attributed to the current month must be calculated and recorded as an expense of the current period. On slide 21, we have a scenario showing the talking about the types of adjusting entries and the trial balance. And in determining which adjusting entries need to be made, the trial balance needs to be reviewed at month end to determine which accounts, if any, need adjusting entries to recognize any expenses or revenues and associated assets and liabilities that have not yet been recorded. For example, look at the office supplies example noted in the text on page 169. It would be an inefficient use of someone's time to account for every single change in office supplies during the month. So instead, an inventory is taken at month end to see what's left and determine what has been used since last month end. The amount used will be recorded as an expense, that is, supplies expense, and the associated credit will be the supplies asset account. On slide 22, again, a reminder of what deferrals are: cash received or paid first, revenue or expense recognized later as service is performed or an asset is used up. Slide 23, as shown here for prepaid expenses like supplies, insurance, and so forth, a cash payment is made for what is then an asset until the asset is consumed or used and is then expensed as noted in the previous example with office supplies. So this is prepaid expenses, and there are some examples that are shown here on the slide. Slide 24. This slide captures what we've been discussing about adjusting entries for prepaid expenses and the reasoning behind it. Remember that the adjusting entry in the instance of a prepaid expense will debit or increase an expense account and credit an associated asset account. This is how adjusting entry has an impact on both the income statement and the balance sheet. And let's stop momentarily there and make an observation on that. So we have our prepaid expense asset account, and again, you don't get hung up on the terminology. That term prepaid lets you know that it is an asset account. Let's say it starts with $1,000 balance, which is on the debit side of the T account. Let's say that a month-end inventory of office supplies. Let's just say that's what we've got here. Office supplies is a common example of a prepaid expense. And let's say that the month-end inventory disclosed that we used $500 of that $1,000 during the month, so that leaves us with a month-end debit balance in this asset account of $500. So we're going to credit office supplies for that $500 that was used up. We're going to debit the associated expense account for $500 for the expenses used. And obviously you can visualize this hopefully in a journal entry as well. And with that, that will end this part of the presentation.